Hi, everyone. Welcome to this episode of Scouting for Growth. This episode is most relevant for the income investment enthusiasts. I'm thrilled to have Steve Selengut joining me today. Steve brings over 40 years of direct investment management experience to the table. He's one of the few investing book authors who has actually managed client money for decades. After steering his clients' portfolio through multiple market cycles, Steve retired from his investment firm to focus on income coaching and writing. He also has his Facebook group where he teaches young and mature investment enthusiasts how to make the most of dividend payments, among others. A while ago, Steve noticed that most investment advisors are obsessed over chasing asset growth rather than reliable rising income. Yet, it is income, not your account balance, that pays the bills in retirement, Steve highlights to me in this discussion. Steve is here to share the fundamental principles behind income focused investing laid out in his book, Retirement Money Secrets. His approach can help investors confidently replace their paychecks with portfolio income streams that grow regardless of market and rates. One secret we will share with you in this podcast is that Steve generated a whooping $14 million in income for his clients just before he retired. That is $7 million in base dividends and investment in interest, plus another $7 million in profit taking. Talk about income freedom. I can't wait to unpack Steve's methods for constructing an income factory portfolio, taking profit systematically and making volatility and corrections your friend rather than your foe. The goal is income independence and financial freedom. So join me and let's dive into this episode of Scouting for Growth focused on income generation strategies. Steve, so great to have you with me on the show today. Hi, Steve. Thank you so much for joining me on Scouting for Growth.
Hi, Sabine. It's good to be with you.
So, Steve, to get started, let's just go straight into it. And I would love for you to tell us who you are and where you're coming from and what got you to write this book around retirement income secrets, please.
Oh, okay. Steve Selengut. I'm a 78-year-old ex investment manager. Up until last year, I managed about $110 million for 150 clients around the US and some in Europe, none in England, but some out of the States.
Oh, wow.
Um, I've been doing this since I started the business in '79. Um, I lived in, I don't know how much you know about the States, but I lived in New Jersey. It's in
Yep.
East Coast, on the East Coast, just 45 minutes out of Manhattan. I used to commute to work there.
Okay.
I had a job with an insurance company in their pension investment department for a while, which is, uh, and I had a defined contribution plan
Yep.
with them, which is similar to the today's 401ks and things like that, except we didn't have nearly as much. We didn't have any selection capabilities. We were able to say, how much do you want in the stock market? How much do you want in the bond market? And that was it. And but they did match our contributions just like today. So I worked in that pension investment department, and I started to meet with investment managers,
Yeah.
and I looked at, what was inside the fund that I was in, and I started to ask questions about it because I used to fly with these guys around the country dealing with our clients. I was in the record keeping end of the the business. But I found out, I guess, a very significant detail about the stock market, and that is the companies influence the advisors. When you have a company the size of Boeing, for example, if they want you to have a lot of their shares in your investment program for your employees,
Yeah.
you then had a lot of Boeing shares in your
Investment.
thing. So the light bulb went off for me, saying that it wasn't just economics like they taught us in college. It's a lot of politics in there too. And
Absolutely.
there are hundreds of money managers and even larger numbers of pension and profit sharing plans within companies that get managed. And these companies influence what the managers do. So I decided that in my investment portfolio, and I was fortunate. I was very fortunate as a young person. I chose my parents well, I like to say,
Oh,
and I
yes.
and so I didn't get out of college with debt. I got out of college with some assets actually, and so I was investing early, and at that point, like I said, the light bulb went off, and I said, "Hey, I'm never going to let a profit sit there. I'm going to take my profits. I'll find something else to add to
Invest.
my accounts." And
Yeah.
that's where it all began. I started making significant money trading stocks. I'm not by any means a day trader. Then that's kind of a dirty word in the industry anyway. I, I waited for 10% profit and I never let it go by.
Yeah. And I think, Steve, you left your job 34 years ago and so started to be on this path around building investment income to replace your salary. So it would be great if you could explain to us what that means.
Okay. Well, what I did, my 25th birthday, my father, and as my present, he said, "Okay, all that money you put away when you were a kid from mowing lawns and doing this and doing that, I put it to work for you, and here's what it is." And he dumped out probably 30 or 40 different stock certificates
Oh,
in
wow.
front of me and said, "This is what," the guy's name was Ezra, his attorney. This is what he's put together for you, and now it's up to you to manage it. So I had Dow Chemical, I had IBM, General Electric, you name it. Any of the big name. I probably had of the 40 stocks in the Dow Industrial Average, I probably had 20 of those and another 20 of others. All I had was stocks. I didn't have any income securities at all, but I was determined not to lose any of it. So I really started to study it. And one thing they all had in common, every one of them paid a dividend. So as soon as I deposited in them with a broker, I
Okay.
started to get dividends coming into the account. Oh, this is a good thing. I'm not working for that. That's nice, you know. And I was working at, like I said, at this insurance company. I wasn't making much money, really. My wife's a paralegal and she was making more than I was, and for a private law firm. So uh after expenses of commuting and all that, you know. So anyway, I started all the stuff you do. You watch the charts, you see the trends, you see how they all go up sometimes, and sometimes just one sector will go up or one sector will go down. So you got the idea what was going on. But if you looked in there, you would see literally hundreds of opportunities in a 20-year chart where you could have bought it at a lower price and sold it at a 10% higher price. And you could have done that pretty much in all of them many times. So there was a second light bulb. I think that's all the light bulbs you're allowed. I'm not sure. But I said, okay, I'm going to start. I'm now going to be really active. And I started trading these things. And every time I traded, I took 25% of the proceeds pretty much, including the profits plus a little bit more. And I started investing in bonds.
In
And
bonds. So you move away from, I would say,
I
share and a dividend into to bond, but is it because of the timing on the market or?
No, not at all. Nothing to do with the timing. The difference is um, bonds are a much safer investment by their nature, and they pay income. The only thing they're there is for paying income. In those days, it was very difficult to trade them because there are markups.
Yeah.
You paid a markup when you bought it, paid a markup when you sold it. You had to pay the accrued interest to the person
Mhm.
who bought it from you. It was very complicated with bonds. So after a few years, I discovered that there are such things as bond unit trusts. And then I discovered that there were closed-end funds
Interesting.
where I could own, hundreds of different bonds for 15 cents a share because within this closed-end fund. And the closed-end fund paid monthly income. So this income side of my portfolio became a money stream. It literally became a money stream. It was a significant amount of money. It wasn't just $20 a month. It was getting into hundreds of dollars a month.
Hmm.
Eventually it got into thousands, you know. So so that's what happened. I put 25% of my money was always in the bond market. And the bond market included these closed-end funds that included um, mortgages, real estate, all the different sectors of, all the different types of income, notes, loans, short term, long term, out of the country, it was just a great diversified portfolio. And on the stock side, I stuck with stocks for a much longer period of time individually because the S&P 500 had a book, a monthly guide. They'd send, you subscribe to it, and it categorized them in what I would call, I came up with what I called an investment grade value stocks,
Hmm.
and they were defined as companies that were profitable, that paid dividends. They were traded on the New York Stock Exchange, and they were B plus or better rated by Standard and Poor's.
Hmm.
That's pretty much all they had to do. But there are only about 250 of them that actually did all of those things.
Yes. Okay.
So a guy I knew developed a program that tracked these things, and he'd send me a list, and I'd pretty much be able to pick and choose what I wanted from that list. And I knew that every one of them met my quality requirements. So all I had to do is create a diversified portfolio from that, and they all paid dividends. So everything. So that income stream number one is those dividends.
Yeah.
Now, the stocks and the closed-end funds would trade up and down in price and taking profits because profits are partly politically motivated. The big companies, the ones that owned hundreds of thousands of shares, a lot of them were owned because of their relationship with the company.
Yeah.
Okay, like
What
we
you were saying earlier. Yeah.
like we talked about earlier. So I set a 10% target on the stock market. If the stock went up 10%, I sold it. I mean, I
Okay.
didn't put a stop on it or any of those mechanical things. I never sold options and stuff like that for more money. But every time a stock got at or near 10%, I had to actually get 12% because it was after commissions.
Hmm.
Because I'm doing this for 100 people by now. Um, and that's what we did. Every time, and that would be it's it's like the idea, stock market goes up and down. Sometimes it's up. Let's say you're walking down the street and there's $100 bill
On the
on
floor.
the on the sidewalk,
Hmm.
on the sidewalk. Do you walk by it and hope that it's going to be 150 tomorrow?
It's a
You
good
know,
metaphor. Yes, probably not.
so say that 100 represents 10% profit, or even a 7% profit if the market's weak, might be enough. You pick it up, you reinvest it. It's new capital. So the second stream of income I developed was this capital gain income.
Okay.
This year so far, And it's 5 weeks. We're 5 weeks into the new year. My personal accounts have generated $20,000 in profits already.
Congratulations.
You know,
Congratulations.
well, I thank you, but it's not for, I'm not bragging about it. This is a possibility. Not only is it throwing off all these dividends in a month, you know, it's the size of my portfolio, the dividends are going to be substantial, but the capital gains are like, you know, getting a check in the mail from your rich uncle and having something more to reinvest. So that's two streams
Streams.
of income. And the third stream of income is, okay, if you're lucky enough to have that rich uncle, he'll send you some money every now and then, or
That's good.
or your grandparents, depending on your age, your parents, your grandparents, they may have, you know what I mean? But it's all money that you can invest. It's more capital, and it's the amount of capital that's actually invested that produces the income. It's not the market value of those shares or those bonds. The shares go up and down in price. That doesn't change, typically doesn't change the amount of money they pay.
Yeah. So you need this capital gain. So when you think about it, actually, Steve, is you wrote a book, right? Retirement Income Secrets. Can you tell us, I mean, and this is to help us, people like me and people out there, to learn how to create income freedom, right? How
Right.
to learn around those different income stream you actually highlighted for us right now, to actually not rely on salary, but learn to actually take profit at the right time. Can you tell us a little bit more about what is behind the book and what got you to write it?
Okay. It's actually my second book. My
Okay,
first my first book was called The Brainwashing of the American Investor, and it was
brainwashing.
brainwashing. Well, yeah, it's kind of the same, just like in the current book, Retirement Money Secrets. I talk about how a person should focus on the income being produced by their assets. I mean, after they screen their assets so they know they have the proper quality, blah, 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 they're diversified, all those rules about investing in general. But at that point, they should be focusing on the income produced by the shares, the bonds, and instead of their market values. Because their market value, they can't spend the market value. They can't spend a gold brick, you know?
Indeed.
You can't spend cotton futures. You can spend cash, and the companies are giving you cash. Then they appreciate your value as an owner. If
100%.
take for example, you have utility companies, and utility companies always were very good at producing dividends for their shareholders. It was like they said, "You're our partners. You're actually our owners, but you're our partners. We respect you. We're going to give you back. We don't have to grow our utility company. You got one plant, you got two plants, that's enough. You don't need to spread out and go conquer the world." So those companies were always good for dividends. But most companies, and particularly in the tech sector, are they want to grow. I mean, that's their I mean, when you get letters from people that tell you they want to help, when you're a coach or you're a professional, they tell you how they're going to help you grow your business, they're going to bring you to scale. That's what these guys want to do. They want to scale their business, just like on that the show on TV, you know what I mean? You know the one
Yeah,
I mean.
Dragon's Den and this type of
Yeah.
things. Absolutely.
Yeah, that type of thing where you meet these people who are going to give you money to scale your
Your
business.
business. Yeah.
Well,
Investor.
you don't need to scale. You don't need that scaling. What you need is to get some benefit from it. And the only reason why you can take advantage of it is taking profits, because these guys don't give you a big dividend. I mean, Microsoft didn't pay a dividend until just, not even 20 years ago.
Interesting.
You know, you know. So I never bought a
And now
stock
it's probably, for a period of time, Microsoft became the most valuable company in the world
in the world.
before
But
Apple.
but it still didn't pay much in dividends.
Yeah.
Didn't pay more than 1%, 2% at most, and that's when the price was down.
Yeah.
But the same with Apple, the same with Amazon, the same with Google, the same with any of the FANG. the FANG companies,
Mhm.
they're not there to give you income. They want you to have that growth in market value to build up that ego, and you have to sell them to use that money, but you won't sell them because you
Steve,
love them. You love them too much.
I have a question for you relating to, some of the changes in the marketplace with regards to, you mentioned, the Dragon's Den, the young companies getting investment funding from, being mega investors. What is your view of, money? Let's call it money supermarket or the democratization of wealth. Think about platforms like Wealthify, platform which allows investors, individuals to invest like people like you. What is your view around this democratization of wealth by using platform where you can actually invest in stock?
Well,
Uh,
you can. I'm not sure. I'm familiar with them. I'm familiar with you know all the different facilitations of being able to invest through the stock market. If you're talking about direct funding of a company that's not public, that's private investments, I think it's a very risky enterprise. I don't think you're going to. Um, there are things like business development corps, BDCs, that seem to be pretty good investments that pay out a large dividend as long as they're successful. But they're only one company. It gives me the same scary feeling. The hair goes up on the back of my neck. You know, what happens if this guy gets in an auto, if the brilliant leader gets run over by a train or gets in a car accident and can't function or has a stroke? What happens?
yeah,
You
I
know,
mean, hopefully there's more
I
democratization.
don't feel protected anymore in an individual company. Too much has happened. I've been through the Enrons. I've been through seeing Merrill Lynch go to zero. I've been through too many crashes um, to even to take for granted that every great company is going to continue to be a great successful company. So what I've done is I've um, mutual funds were developed. I'm jumping from a whole nother. Mutual funds were developed and started to get popular uh, after the crash of in the 20s,
Yeah.
the Great Depression. Mutual funds came along years later because everybody's afraid of the stock market at that point. Too many people jumped out of windows. And so people were afraid. So mutual funds said to them, hey, we're giving you a diversified portfolio. You're going to own the world. I mean, you're going to own all the companies. So it's much safer. And you can participate now in the growth of the economy again without the fear of 100% loss if a company goes bust because we own so many companies that if one or two of them go bankrupt in a recession, excuse me, um, it's not going to be that big a deal. Well, that's helped, and that brought a lot of money into the marketplace. It helped the rise of profit sharing plans
Mhm.
and IRAs can develop because all of these things use funds and mutual funds became a bit one of the biggest operations of all. Before mutual funds, there were things called closed-end funds 20, 30 years earlier. They were different, but they did this. But it was the same premise. The same premise. You're gonna buy a diversified portfolio of things, and there's not an investment advisor out there or if or there shouldn't be one that would deny the fact that diversification is one of the key elements of risk minimization that you can employ. Um,
And
you
for
know, so that
you, Steve, it's about income, right? Focus
yeah,
on proper income, not asset value. It's what you also highlighted.
yeah, right. But the point is that in order to keep that income secure and that income safe, first of all, you got to invest in a company that respects you enough to pay you
Yeah.
income or a fund that wants to pay you income. That's why it's there. right? And you have to diversify properly so you don't have too much risk. And you have to make sure the quality is there, so quality, diversification, and income are the three of the four legs of the diversification um, or risk minimization stool, if you will. You know, if one leg's gone, you're not you're in trouble, right?
Yeah.
So that's where that all
So
is.
one thing I remember as well from reading about you, Steve, is you manage over $110 million in client asset, right? And
Right.
had an amazing year. I think I can't remember which year where you made over $14 million in income, right? $14 million in income in one
Well,
year.
that right.
That is a standout performance. Tell us a little bit more about that.
That was 2021 when we had that great rise. And in fact, that rise lasted into the beginning of it was into 22. It lasted into 22, and it actually started um it was all, let's say, all 221. So during 2021, and I'm not exactly sure what brought the interest rate sensitive securities up with the stock market itself, but the stock market just went nuts, basically.
Okay.
And everything, the Dow, or excuse me, the S&P hit new all-time highs 70 some times over the course of the year. The Nasdaq kept rising until November 2011. The Dow continued into 22, so the S&P had its last all-time high on January 3rd of 22. But during that period of time, uh, everything was going up in price. And I was totally in these closed-end funds, but my income closed-end funds, I was taking for my clients, and I would call the broker. We were probably doing two or three hundred trades a day,
Mhm.
and we were taking $30,000 in profits a day for months at a time. It was just we had never experienced anything like it. Um, and of course, my ideal situation is you never leave those dollars sitting on the sidewalk. So I'd call up every morning and she'd say, "How many we got today?" I said, "Well, we could have as many as 100 cells with all our clients."
Mhm.
And we'd start doing orders throughout the day. And at the end of the day, we'd be hitting that $30,000 level a day. And of course the income, and we were able to reinvest because my universe to select from is over 200 different positions. And we things we sold 2 or 3 weeks earlier, we'd now buy again,
Yeah, as
and
they
then
are going down.
and but you don't buy as much of it because when you're in a rising market like that, eventually it's going to go down. The
Mhm.
market is cyclical. It's a cyclical beast. It doesn't just go up.
Mhm.
And sometimes it goes up and down a lot in short periods of time. So when you're buying into a high rising market, when I'd usually start off with, let's say, you know, $2,000 or $3,000, or depending on large portfolios, maybe $6,000 or more in a single position, I'd only buy half that much
Mhm.
because in your somewhere in the back of your brain, this isn't going to last forever. You can't be just going up and up and up. And eventually, when the market went down, we were we didn't have large amounts of profits left there. I mean, we had taken them all. Some days we were taking 20 in a big account. We might take 10 profits of over 7%.
Mhm. That's really
Yeah.
cool. But
Mhm.
so, Steve, do you think the biggest portfolio income mistakes people do when they retire or are, near retirement today?
Well, near retirement, they should be starting to emphasize income in their portfolio instead of equities because they're safer and typically they produce more income. In the closed-end fund arena, equities pay a lot of income as well because their same focus is, think about it, a rising market, they're going to take profits, but they got to get out to 95% of their profits.
Yeah.
So they're still going to pay you a good, tidy sum. But the risk, the overall risk, recession risk and depression risk and so forth is higher in stocks. So you want to get back into more into the income purpose bonds and mortgages and real estate and things like that. Um, but most people's mistakes are, particularly if they've worked for a big company and they have an employee stock ownership plan or their 401k allows them to have a lot of company stock as an
Mhm.
investment. Most companies that are very successful don't pay a whole lot of dividends. So they have could have literally $1 million of XYZ company and it's paying 2%, $20,000 a year. If you have $1 million in diversified equity closed-end funds, you'd be making 90,000 a year
Mhm.
of spending money. So they need to change their focus from feeling rich to actually being income independent, you know.
Interesting.
And that's the first mistake. They fall in love with their company stock, they fall in love with their Apple or their Amazon or their Google, which is great, great, wonderful companies that have done so much for so many people over time, but they don't pay any income. So unless you're willing to sell a little bit of at a time to fund your life,
Yeah.
what if you want to see the world? You know, if you got to, let's say you want to go see Antarctica. You know how much a cruise to Antarctica costs these days for two people? I haven't done it. It's, I don't, it doesn't interest me quite as much as it does the African safari type of things. But these types of trips cost, a
A
lot of
lot.
money,
It does.
and you don't want to be selling your securities to do it. You want to be able to say, okay, I'm not gonna reinvest, you know, $10,000 the next 2 quarters, so that I'll have enough to go on that vacation.
Yeah.
So, and an income focused portfolio allows you to do that. I mean, I've been, literally, my wife and I've been literally all over the world in the last 10 years.
Very nice. Congratulations.
Crazy, like we've been right, right there where you are on the in
I
the
know you
aisle
mentioned
in the aisles. We've been in stuff in you know
nice places. So what are, you already
Ireland,
mentioned
Scotland, we've
some
been all over.
amazing tips right now, Steve. You have mentioned already some good, some mistakes people are doing so to actually reframe the way they look at investment and turn it into, income. But what I hear from you is a sustained approach to doing that. In some ways, maybe building an income factory where you have different parts of the model, right? Helping you achieve your long-term goal to have this, what you call income freedom. So what are some tips, people need to remember to get onto that journey?
Oh boy. To the idea of having uh let's think of there's a lot of different closed-end funds and they all pay an average right now of around 10%.
Okay.
Okay. And the reason for that is they're interest rate sensitive. Remember, I mentioned before how utilities, um, they weren't as high flyers because, they paid out a lot of income, but they're not growing so much. They pay out a lot of dividends. But when interest rates would go up, they would go down in price.
Mhm.
It's the same with closed-end funds, both sides, income and equity, because they pay off so much income, and many people like myself use them as income producers. When interest rates go up, they go down in price. When
Mhm.
interest rates go down, they go up in price, which is why something like 2021 happened. Interest rates was zero. So if something, and at that time, these things went so high that they were only paying 6 or 7%, not 10% like they are today with interest rates higher. So if you think about, you've got this huge mass of qualified income producing securities, both income and equity that you can choose from.
Yeah.
I have, if I include the tax-free bonds, and I don't know if they work in England or not. They wouldn't. they're US, so they wouldn't, I'm sure.
Yeah, we
But
we do
you
have
you
some schemes.
probably have
Yeah,
something like that, right?
correct.
Okay. So you
ISA,
take, yeah,
ISA, we call them ISA.
okay. So you have all these things to choose from. You've already checked them all out. They're all diversified. They're all high quality, all pay high income. They also all have a range that you can see where you could have taken profits here and there, that they go up and down in price adequately. You want that. You don't want straight lines. You want jagged lines. So you can think about it in two ways. You think of them like a department store that you have, and all of these things are merchandise on your shelves. They represent every aspect of the economy,
Hmm.
every type of companies in there, every type of product, you know? So you open it up to the public and you say, I've got a 10% markup on all my stuff in my store. If you want to pay me more than that, if you want to pay that, you can take it. I'm not going to say I'm not going to hold out for more money. I'm not going to say no. I want more money. This is my markup. So people come into your store, they buy what they want, and they give you money, and you
Yeah.
go and you go push another button and add another product to your inventory. So if you think of it like that, it's just merchandise. You don't want to fall in love. You know, each of these things are doing its own special job. While they're sitting there, they're giving you 10%. Well, if you can tell them sell them for a 5% profit, okay, you made 15% for the year. It's not great math really, you know, but think of it like you got 5 months in advance or 6 months interest in advance, that type of thing. And you keep doing that. And you keep buying, putting in the same inventory back in again later. And that's one way to look at it. Another way to look at it is pretty much the same type of thing. You've got this cash flow. You got, like we talked about, there's streams of income, and you know that you're coming. Let's say you're averaging 10% on these 200 things. You don't have to own 200. You could own 80 of them. You know what I mean? But you're averaging 10%. Well, 10% is only 3/4 of a percent a month.
Hmm.
So if you're going along and prices are down and you got a chance to take a 2% profit, that's like 3 months worth of income, and you can reinvest it in again. But you've created capital. You've
Yeah.
created new money. That's that check in the mail from your rich uncle. So
Mhm.
you can buy more securities. So far this year, I've been able to buy $20,000 in new securities just by taking profits on my existing securities and replacing them. So that's the type of, you got to get yourself in that framework where you're
Yeah.
focused on the income. And even in the Facebook groups that I have that we discuss this very process, the woman who, maybe I shouldn't say, the person who helped me ghostwrite the book
Yes.
is now using this process. And she'll sometimes say, well, it yields 15% and I've only got a 7% profit. Why should I sell it? You
Interesting.
know?
Yeah.
And I say, because it's there.
Because it's
And
there.
tomorrow it might not be.
That should
And
be your trademark, see, because it's there, right?
because, right, there you
Because
go.
it's there.
So something like that. Yeah. So
But one
go
thing, sir,
ahead.
I think it's important you mentioned this lady who is part of your Facebook group. When do you think is the right time to start shifting our mindset and thinking about,
Oh,
achieving and growing reliable income?
well, that's a really good question. I think it's essential to do it when you're within 5 years of retirement.
Okay.
Essential. You got to do it. You got to bite the bullet. You got to take your tax bite on those big profits you have that aren't paying you any income
Yeah.
and get that money working for you. The other, and it's probably not something that you would think about, but the other point in my experience, and to me it was very important, was to, as soon as you have some money to invest, always put a little bit into what you call your income bucket or your income asset allocation so that it can grow. And if you use, I use what I call the working capital model. and you
Hmm.
talk about it in the book, where I focus on the cost basis of everything, how much I actually invested, and how I'm creating more capital when I take profits or when I add to it or when distributions come in. That grows my capital. And it's my capital that does the work of bringing in more money through
Yeah.
dividends and interest. So I focus on that instead of on market value. So putting that, putting 30% of your investment assets based on the capital in income securities. And with every new bit of money, putting 30% in the income sector or the income asset allocation, you'll grow your income every month. You'll grow your income every year. And eventually you get to where I was when I was 34 years old, where my income from my two streams of income were generating 5 times what I was making.
Yeah.
So I could say, thumb my nose at the old employer, stop commuting to New York and start running my own business because I could afford to get started on what I was making from my investments. And the sooner you start putting something, and I'm not saying put a lot, put when you're in your youth, you should put 70% at least in the stock market, because so long as you're so long as you're disciplined enough to take your profits.
Yeah.
And then the rest of it, keep growing that income, keep growing that income. And then when you get to be, well, when you get to be 20 years younger than me, you can start thinking about retirement. I I for all, well, I retired when I sold my business last year, but clearly I haven't retired. I've been
Well, you're
running.
continuing, right? And you are
I,
coaching and teaching others to do it as well, which is a
yeah,
reason for the book, Retirement Income Secrets, and your Facebook group as well, where you are providing and coaching
right.
people to learn to do it the right way. So, my last question to you, Steve, is, what are the key lessons actually people you are coaching every day are
Yeah.
learning from engaging with you?
Well, the lessons are, we've already we've done pretty
Quite a few,
thorough, we've
but
done a
just a
pretty
summary.
thorough job up here. But the lessons are to, and one we haven't really mentioned is understanding and respecting the market cycle.
Yeah,
They learn not to panic every time the market goes down. Instead, they're
tons.
they rub their hands together almost as nicely as they do when the market goes up, because that means this one says I'm going to get some profits, and when it goes down you're rubbing your hands because I'm going to get some bargains. I'm going to be able to, and my yields from my new money I put in, the yields are higher when the prices are lower. So you have to look at the market cycle as the opportunity you need to, uh, people say buy low and sell high.
Yeah.
Yeah, I say you buy lower and sell higher, because you don't know where low is until it happens, until you get out of there, then you know. And you
Yeah.
don't know where high is either. Just like 3 days ago when the market was on February 2nd, the market was at an all-time high. It's not now,
Yeah. Yeah. My husband was just telling me
you
a
know.
few days
So
ago. So, yes,
and
it's
so
not,
how far is it going to go down this time? Who knows?
who knows? But you
You
have
don't.
bargains to go
So
after.
right. And what you do, you just don't want that to be a big care. I don't care. I want the market to go up and down. It's an
It's part of the
opportunity,
game.
and you
Indeed.
have to organize your portfolio so that you can do exactly that. You know, that you're going to grow your income whether the market goes up and down or whether interest rates go up and down. And those are the two key factors that affect your portfolio: interest rates and the economics that, dictate where the market's going.
Steve, last word of wisdom. So think about, people listening to this conversation. You will find investors, investors investing in startups. You will find tech ventures, tech founders, some of my
Right,
age, some
right.
younger. You will find people, corporate executives maybe going into retirement, but also looking at new ways to think about money in some ways. what would you tell them? What would be the last word you would tell them around how they can be positive around high market, low market, around all the recommendation you gave us today?
I can tell you a thing I think that everybody who's listening to this should do um, at any of those stages in their career where more income would be important to them.
Yeah.
And that is to talk to their financial advisor. And first thing to do is ask them a question. How much income? What's the yield on my total portfolio? How much, income is it producing? And how much is it producing after fees?
Yeah.
Those two things. So you get a real handle on how much your income is and how much they're getting. Okay.
After all the costs just being
And
covered.
then you want to tell them, look, I want two things. Two things. I want this portfolio to generate no less than 6% income. And I want your fee to at least be covered by the capital gains that you produce for me over the year.
Superb.
You know,
Thank you, Steve.
so if you talk to them about that, and since you've read the book, you know how to do it.
Yeah.
So that would be
Since you have
that's
read
what I
the
would say.
book, Retirement Income Secrets, and we all know how to do it, we should be able to ask the right question. Steve,
Right.
thank you
Exactly.
so much for joining me on Scouting for Growth. And thank you for an
Well,
educational lens around investment income. I've learned some tips. And by the way, you need to know that when I built my first business, I actually took my profit from my IBM shares, and that was 10 years ago. So
wow, that's great.
I did learn a few techniques as well a few years ago, but now I will probably be much more thorough in applying new techniques you have teach us today and which are in the book as well. So
Well,
thank you
that's
so much.
great. If you ever have any questions, just ask.
I will. And I
Okay. Now,
will.
now that we know each other, call me or email me. Yeah. Okay.
100%. Thank
Great.
you, Steve. Thank
Great.
you
Thank
for
you so
joining.
much. Thank you so much for having me.
I hope you enjoyed this episode of Scouting for Growth. Please subscribe, share with friends, and leave a 5-star rating. Your rating is so valuable. I review all of them, and my team help me adapt content to meet your needs. Also, connect with me on my preferred channels. I am a B2B growth expert, so you will find me on LinkedIn, Instagram, and Threads, and X as well as Blue Sky. All information available below. Until next, keep scouting for growth.